Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kurt Chisholm, and I'll be your host. So today I'm joined with Eric Crittenden. How you doing, Eric?
I'm good, Kirk.
Good, good. Glad to have you here. Well, want to bring Eric on. Some fascinating stuff we're going to be talking about today. But before we begin, Eric, tell us a little bit about your background.
So my name is Eric Crittenden. I am the Chief Investment Officer at Standpoint Asset Management. Uh, we are an alternative investments firm that focuses on what I would characterize as all-weather investing. So essentially, we mix different hedge fund styles together with traditional assets in pursuit of stable, what I would like to characterize as reasonable returns, regardless of market conditions. That's our goal. My background, I studied meteorology in college and public health, and quickly realized there was no money in either of those two industries. Took an elective in economics, fell in love with dynamic systems, transitioned over to finance, and studied some computer science, and then entered the world, kind of like you did in late '99, is when I became a money manager and learned some very valuable lessons about risk management, investor behavior, investor psychology, and over the next 25 years tried to take that knowledge, convert it into wisdom, and run well diversified global portfolios for myself and clients.
Nice. Well, it sounds like in college you did a little bit of a lot of things.
Yeah, a lot of migration. I was in college for 9 years. I was a good
Wow.
student, but I kept changing my major. And when I started getting gray hair, I realized it was time to graduate and go earn some money.
Time to get in the real world. Nice. So all weather investing. So we wanted to bring you on the show because I know all weather investing, at least, I don't know if he originally created the idea, but certainly if I first heard about it from Ray Dalio, it became sort of kind of a thing. So why all weather? Like what about that is appealing and why that versus all the other strategies out there?
Yeah, personality. I think, like you, I lived through the 2000s and saw how going with the status quo and conventional wisdom has you on the wrong side of some really big trends during bad times. And losses matter more than gains over the long term. It's very, very important to manage your downside risk if you want to finish the marathon. So all weather, I'm a big fan of Ray Dalio and Bridgewater and what they've accomplished, but their concept of all weather is somewhat different than mine. Essentially, when you look at all weather historically, it is similar to risk parity, where you're taking equities and you're blending in leveraged bond positions under the assumption that those bonds are going to work and produce returns when equities struggle. And historically, that's generally been true. However, it's very consequential when it hasn't been true. So I like to focus on the 1970s as I see that as the primary blind spot for most investors today. They just don't have a solution for defending and even thriving during periods of stagflation where stocks and bonds become positively correlated. So what I did was study all the financial data from all the global markets going back to, I'd say, the late 1960s and try to figure out what is the best diversifier. If you're going to have an equity centric portfolio, a pro growth, GDP dependent portfolio, what is the best diversifier to lay in there to give yourself a good shot at having stable, reasonable returns, even in bad market environments? Bonds are a good solution about 75 to 80% of the time, but they're a terrible addition the other 20% of the time. Is there anything else out there that you can put into the portfolio that has a good shot at thriving when you need it the most? And what I found is that the data suggested to me strongly that systematic global macro managed futures style trend oriented investing is by my definition the best diversifier and has been for many, many decades. So I set out to create my own macro strategy and blend it in with risk assets and fixed income in pursuit of something that can handle a very uncertain future. So that's what we do.
Interesting. So you employ trend following as a part of your approach. So how do you how do you employ it? Because there are times where trend following is horrendous as well. Like there's no strategy that works all the time perfectly.
Correct. Yeah. So the first thing to make sure that you're doing if you want to get decent results from trend following is don't pay the 2 and 20 fee structure to the hedge funds. So that ends up being about a 6 to 7% headwind over time, and that's just very difficult to overcome. So what that means is that we have to build it in-house and run it in an efficient, low-cost manner. So we've done that. You're right that trend following has lost decades. It goes out of favor, and it's very, very difficult to maintain on a standalone basis because psychologically, it's tough for investors. When trend following does poorly, stocks generally are doing well, and that relative performance difference creates a lot of envy. So, but if you pull it all in-house, you can use the same pool of capital to finance your equities, your fixed income, and your trend following at the same time. And as you know, portfolio math is very counterintuitive. So if you bring in uncorrelated assets, they don't have to do well when everything else in your portfolio is doing well. In fact, that's a bad thing. It means you don't have any diversification. So, long story short, trend following historically tends to work well when stocks are doing poorly. It tends to work well when bonds are doing poorly, and it especially tends to do well if stocks and bonds are doing poorly at the same time. And that's what's important. But you do have to have the discipline to hold it when trend following or macro isn't doing well, and that's quite often as well.
Yeah, it's interesting you say that because we had that, what, 2 years ago now, where stocks and bonds did very poorly, and everyone was surprised. They thought, "Whoa, this never happens. Why, why is this happening?" It's like, well, it has happened before, but somehow people were surprised, even though the Fed telegraphed that pretty much well in advance.
And that was
Um,
just 1 year. You know,
right.
the 70s was a 14-year period of time, like 68 to 82, where that would have been your reality for a lot of that period of time.
So how do you invest in periods like that? Because I mean, you're an expert, you've got access to a lot of things that most people don't. But how should people be thinking about that? Because if you've got a stock and bond portfolio, which is what most of the retail public has, stocks are doing poorly, bonds are doing poorly. Where's the safe haven?
Well, by my calculations, there's three things you can look at. Gold, very short-term fixed income, where you're able to reinvest those coupons into a rising interest rate environment, or systematic global macro. So those are the three that historically have stood up and delivered to some degree during those hard periods of time.
Yeah, I know short-term fixed income's hard for people because we've had 20 years of 0% rates, and most people think that, well, cash is bad. Even Ray Dalio says cash is trash. It's like, well,
Right.
not in 2022, it wasn't.
Right.
Um, so, so talk to me about gold a bit because gold obviously has done well in the last year. Certainly had a period of lackluster returns and has done well in the last year. Um, but maybe some might say, all right, it's gone a little too far too fast. What does gold look like in your lens? Like, how do you look at that as an asset class?
I try to avoid the dogma from any sector of the industry. So I'm not a gold bug. Um, it's just another market in our toolbox that we can use. Like we're very long gold right now because it's in an uptrend and has been for some time now. It's in the macro program. So is if gold is trending higher, we're going to have a long position in it. If gold does what it did in the 90s or 20 years of going down or sideways, it's probably not going to be in our portfolio. So I'm agnostic to gold. I was simply pointing out that if you just look at the historical data, gold has been a reasonably good diversifier to a stock and bond portfolio, but there are no assurances it's going to be a good diversifier going forward if you view it through the lens of a buy and hold investment.
Yeah, I mean, what other? I mean, gold's it's kind of a commodity and it's kind of something else. I mean, it's a little bit different than commodities, but um, how do commodities fare in times like this? Is it just gold or is there other commodities as well?
Yeah, there's all kinds of stuff that's moving right now. Cocoa and coffee are soaring, huge uptrends. A lot of the grains, soybeans, corn, wheat, are in pretty significant downtrends and have been for a couple years now. The metals, not so much. There's copper, there's gold, silver, platinum, palladium, nickel, zinc, tin. There's a whole bunch of different metals, iron ore. Haven't been doing a lot for the past year and a half. So in that situation, we just avoid them. Our macro program is very disciplined and trend oriented. So if something's not doing anything, we'll just ignore it and leave it out of the portfolio. It has to stand up and deliver and get our attention in order to add it into the portfolio. So different environments will give you different results. In the 70s, commodities had prolific trends that were sustained 5, 6, 7 year bull markets. We're seeing some signs of that, especially in the soft commodities this time around. I mean, you saw it during the inflation a few years ago, where I think cocoa prices were up 5 or 6x over a 3.5, 4 year period of time. So we're starting to see some of these supply demand disruptions manifest into prolific trends, and we're able to capture many of those. Right now, it's a mixed bag. It really is. The cross currents that I see in the market right now are about as high as I've ever seen. Not a clear picture.
Well, how do you translate that? So when you see these cross currents, I mean, things are kind of a mess, and being a macro investor, from people I've talked to, is probably one of the harder times in the last 50 years. So how do you translate all that, that things are a mess? Like, what does that mean to you?
I use simple algebra and I just wait for breakouts and trends to emerge. And then we will invest in those trends on a risk managed basis. We'll take our risk budget and we'll look at the liquidity in those trends as they develop, and we'll look at how much risk we're taking to the portfolio level. And then we will buy into these new trends as they develop, and then wait, 2 quarters, 3 quarters, 4 quarters for the justification and the logic to play out. So that's the nature of investing in these other asset classes. You don't find out why they're moving until after they've moved. So we're completely technical in our participation and don't get caught up in the justification, because if you wait for the justification, you're usually way too late.
Yeah, yeah, I think that's I think that's a smart way to think about it. Um, all right, so you're as your global macro, obviously, you're looking at trends around the world, not just the US. I mean, I'm certainly familiar with US trends, but how do you analyze international trends? Are you traveling all over the world, or how do you look at things which are highly complicated with cross currents of different markets?
Yeah, by distilling everything down to data. So we collect data from almost every futures exchange on the planet. I mean, we don't do Russia and Venezuela, but most of the futures exchanges, or at least anything that we're legally allowed to participate in from the US, we will collect that data on a daily basis. Download it at night. It goes into a sequential database where it's cleaned and processed and then converted into total return streams. And then we run our operations on it, and we sift through that data, and then the rules that we have in place tell us, which markets are statistically in an uptrend, which are in a downtrend, or which have no trend at all. And then we look at their correlations, their liquidity, and assemble a portfolio. It's actually not as complicated as it sounds. We're not very active. We're kind of medium-term trend followers, which means, we have maybe a new trade every week and a half, 2 weeks, something like that. But I'm just looking at the total return stream of these markets and looking for trends. So I don't have to travel to places. I don't need to talk to government officials and whatnot. Like I mentioned earlier, by the time they're telling you what's going on, the markets generally have already started to move.
Now, we've had a lot of big macro events, in the last year, and certainly we're having more with the recent election, and a lot of stuff going on prior to the new administration taking power. How does all that play in? Do you look at that at all, or are you just looking at the prices?
Just looking at the prices, the term structure, and the liquidity. They generally tell you in advance that chaos is coming. If you look at like the betting markets for the election, they had it nailed. So I trust the markets more than I trust the distilled um, output from the media. I'm not trying to criticize the media. I'm just saying by the time the editors and the accountants and the marketing people and they put the gloss on it and it's been proofread and it's distributed out to the public, the markets were looking at that days ago. So we just look at price, term structure, and liquidity.
Yeah, I think it's fair to criticize the media. I think you're safe.
Half my clients will pat me on the back, the other half will chastise me. So,
Well, interesting. So, all right. So how does inflation play into your calculus? I mean, when you mentioned earlier about the 70s and studying the 70s, which is a very interesting period. I love studying the 70s, and I thought we were going to have a repeat of the 70s. Uh, Although it appears as if they may have squashed inflation, but who knows? I guess that's part of the problem. You don't know. So, what's your take on that? If you just had to take a step outside the technical analysis box, like how would you analyze this period today as compared to the 70s?
yeah, if I separate myself from the discipline that we adhere to in investing and just start thinking about what's my opinion, um, what we have is considerably worse than the run up into the 1970s. So I'm not one of those people that thinks inflation's been quashed. Um, if you look at the algebra of total economies, the path of least resistance is to the monetization of that debt. That's just the smartest way to move forward. It's not the fairest way to move forward, but it is going to be the path of least resistance. And that means more inflation. Now, you could get a completely different outcome because there's technologies and stuff that we can't conceive of that is going to change the trajectory going forward. But just the baseline right now is it's a mess, man. It's like the late 1960s. Well, no, I would say that the historical analog, I'd say we're like 1972. So, and we may get something that rhymes. I mean, if you put a gun to my head and say you have to be close to right, I would say it's some mixture of the Great Depression, the 70s, and the early 2000s is what we are facing at some point. Not imminent. It may be imminent. It might start today. I don't know. But at some point in the next 10 to 15 years, the bill's coming due and someone's going to get stuck with that bill. We just don't know how that's going to play out. So, inflation, it won't surprise me at all if it's sticky and it comes back and it's a significantly higher number than people are comfortable with.
But what would bring it back? Because I mean, like I said, the 70s is an interesting period. And there are a lot of reasons why inflation picked up, and some of which may not be repeated. But we had inflation, quote unquote, squashed recently. And what is going to bring it back? Because in my thesis, because we had money printing for long periods of time, and then it wasn't until COVID where it started to pick up. And my thesis has always been, well, the supply chain is a bigger impact than people think, and the demographics are a bigger impact than people think. The printing of money they don't seem to be printing much money because it's not causing inflation necessarily. Um, Now, giving it to the people was a little bit different as well. So we had a lot of different variations off the norm in the middle of COVID. But what would cause it to come back? I mean, they're not going to, unless we have something catastrophic, they're not going to start printing up money and giving it to people. So that's not really a viable scenario at the moment. But what else could bring it back?
Decoupling from China could bring it back. I mean, the supply chain problems, I think we're in the second inning of addressing those going forward. The reindustrialization of North America is a very large, big undertaking. That's going to take more than 4 or 5 years. It's kind of a 15-year project if everyone does their job and everyone commits and they're willing to, take their medicine and pay for it. So if you model all that out, the cost of capital really should be about twice what it is right now.
Okay.
So that's one thing. But for me, Kirk, the answer is always it's whatever we're not prepared for or expecting. Like we've both been humbled by the markets, right? We've seen good times and bad times. Um, how many times in life, if you go back and in knowing what you know now, how could you have predicted what was the next 5 years were going to be like every year since you've been in the business? There's nothing there, right? It's like you have no idea what's coming next. It's out of left field. It's this new thing. You're never even heard of it. How's that even possible? I'll give you an example. We did pretty well during COVID. And people asked why did you do well during COVID? When the stocks were down 34% year to date. And I said, well, it wasn't from stocks. We were getting murdered in stocks like everyone else. We were down 34. We had big short positions on in global energy markets. And then people ask me, well, why did you have those short positions on? And I said, well, because they started to break down. The trends, the term structure inverted, went into a deep contango, and the prices started going down. And they went down in such a way that they triggered, all of our disciplines to go short, all the energy markets that are freely traded in futures markets around the world. Now, at the time, crude oil was trading at about $67 a barrel. And I had people asking me, they're like, what is wrong with you? Why would you short crude oil at 67 a barrel? It's already down so much. How much lower can it possibly go? Well, it went to negative 37 a barrel, negative, which nobody even thought was possible. Um, and the only way to have prevailed during that market environment was to put that very uncomfortable macro trade on before it makes sense, before people realized that Cushing, Oklahoma, that the storage facilities were full and the price of storage can go parabolic and there's nowhere to put the stuff. So they actually have the price has to be negative. You have to pay someone to take this and go store it offshore. So you couldn't have foreseen that. In early 2022, when we started getting signals to go short every bond market on the planet, that made no sense either. Nobody was patting me on the back and saying, that's a great trade. That's a smart move. They were saying, that this is, I mean, interest rate, the market can't handle higher interest rates. The Fed's not crazy. I mean, we're already so fragile. That was when we first started shorting bonds. And you know what happened in 2022. So could I have foreseen these things? Maybe part of me could put that in there as a scenario, but would I have had the confidence on a discretionary basis to say that's how it's going to play out? No, and I don't know anyone who does. Do you?
Well, there are people who say they have confidence, and there are
After
people.
after the fact.
Yes, there are a lot of liars on Wall Street, that's for sure. Um, yeah, it's interesting. I mean, that's one thing I like about technical trading is because you take the emotion out of it, you take the logic out of it, you take the, quote unquote intelligence out of it that everyone thinks they're really smart about. Um, but it's interesting because if you think about, like, I thought about COVID and I saw a lot of correlations between the 70s with the um, well, actually with a lot of things. If you look at all the correlations are starting to line up, but some of them didn't pan out, right? Because you tend to want to see you want to see things that aren't there, right? You want to try to predict the future because you think, oh, well, there's three things out of 10 that are lining up. Everything else is going to line up. I think a lot of people get stuck into that, but I am a bit curious, just hypothetically. You said the cost of capital could be 2x what it is now. I mean, I don't know why they dropped it 75 basis points to begin with. I think it was fine where it was before they even dropped it. And now they're kind of stuck because they've dropped it. And what are they going to do? They're going to keep dropping it. I mean, we didn't need to drop it to begin with, but I'm not sure where they go from here or how this kind of plays out in your opinion. But how do we get to a 2x cost of capital from where we are now? Like, doesn't something like what has to go wrong for that to happen? Because there's no catalyst to get us there right now.
It's a good question. Let me say this. I'm not in the camp of people that cares a lot about what the Fed's going to do. Um, I when I look at the Fed's behavior historically, it really does look to me like they just follow the 2-year Treasury yield. If you lay those on top of each other, there's not a lot of divergence, and the 2-year almost always moves before the Fed. So I'm not trying to disparage the Fed or people that follow them. What I'm saying though is the Fed only controls that one interest rate. They're not dictating the yield curve. I mean, you could start to see yield curve control, but that's pretty extreme. My point here is the bond market's going to do it. And why? So why would the bond market push rates higher? Same for any market. The market is designed to clear and bring buyers and sellers together at a price that they're both willing to transact. It'll find that point. So you've got people that are willing to buy bonds, and then you got people that are willing to sell them. And the equilibrium point at an interest rate that's 2 or 3 times higher than right now can be um, mostly a function of one of those parties either unwilling to step up or simply just, not willing to lend. So, yeah, I would watch the bond market. And I mean, look, they said the same thing in the 70s. Like rates can't go any higher. They're at 5, they're at 6, they're at 7, they're at 8, they're at 10, they're at 12. They went to 18 at a time when we simply couldn't afford it. So, if you look at just the raw math of the reindustrialization plan for America, uh, I, yeah, it's not going to surprise me at all if rates are considerably higher. How they get there is, just nobody wants to buy the bonds.
Yeah, I guess that's a good point. I kind of wonder, you see these big macro trends, right? You see the nuclear trend, right? And it makes a lot of sense. And it's been what, in the past year, they came out and started to support that. But of course, it takes what, 10 to 20 years to build a nuclear reactor. That's transformative, but it's going to take a long time to build those. Like you said, there's a reindustrialization of the US, which is a great idea, except it's at the same time it's kind of not. I'm also seeing more of a regionalization of the manufacturing, from removing it from China, but not bringing it necessarily back here, but bringing it to other countries, which are still cheaper, more expensive than China, but cheaper than the US. Supply chain otherwise. That's kind of what I've been seeing, and I don't know if Trump will be able to cause manufacturing to come back to the US, but to me it seems like a bad idea if you're going to be paying twice as much for or more to create stuff here. So I don't know what's with the supply chain. Do you still see further hiccups coming, or what does that look like from your perspective?
Well, the disruption, I mean, there's a scale issue. China's enormous, and they've been very, very good at what they do. But they've got their own demographic problems that are considerable. They've got obesity problems now. They've got demographic problems. They've got labor cost problems that aren't really solvable. And a lot of people argue they've been doing everything wrong from a fiscal and monetary perspective for so long that they're trapped now. And that shows up. I mean, look, you're not building, they're building semiconductor plants down the street from me that are enormous. They look like cities. That's extremely expensive to do, and you wouldn't be doing it if you weren't going to follow through. I'm in Phoenix, Arizona, by the way, and Taiwan Semiconductor is basically building their own city out in the desert across from me. Um, and then the scale issue is significant, meaning like, Mexico is very good at manufacturing and they're right there and they want the work, but they're tiny compared to China. I mean, maybe they could do 20% if they really do an epic once in a lifetime build out of what China was doing. Probably more like 15%. So there's Vietnam, certain parts of Malaysia, these places can pick up the slack. But the point I'm trying to make here, though, is you go from this thing, this very efficient thing that's become bloated and corrupted over time. And now you need to transition. You basically need to decentralize it and start putting it different places. That's going to be disruptive. And when you first start doing it, it's probably going to make the symptoms that you're feeling worse for a period of time because it's disruptive. There's communication problems, there's expenditures, there's all these things you have to do. So you go from, you stop this addiction to this thing that's failing and you start doing the right stuff. Well, those first few innings of that probably aren't very pleasant. So it won't surprise me at all if we get things that look and feel like supply constraints that spike interest rates and create inflation in certain pockets. And then I don't look, Trump and his administration, probably have some great ideas, but they're facing stiff headwinds. And these same argument, right? Like you try to lower healthcare costs and tuition costs, like you got to take some medicine. Like it's going to be expensive and there's going to be conflict in getting that done. It's not just going to be, well, now they're in power and everything's going to get better right away. No.
Yeah, no, that's for sure. They definitely got a long road ahead of them. I'm curious about India. Nobody ever talks about India. And if you think about, a country that has, massive population, probably underutilized, highly intelligent, um, you know, why why are people not on the train to move everything to India? Are they not? manufacturing kind of base centric, or what's your opinion on that country and where, what the opportunity set is?
So there's a guy out there named Peter Zion that does a good job of explaining why certain countries have, educated people and a good work ethic, but they still can't get anything done. Has a lot to do with the logistics and the geographic reality of where they are. Do they have deep water ports? Do they have functioning roads? Does the land and the terrain even allow for the cost effective production of roads and transport? Do they have waterways that will allow for transport? And the answer for a lot of those things is no in India. They have smart people, ambitious people, but they don't have rivers that can support transportation. It's mostly tropical. There's just a lot of stuff that you can't do. The United States has a geographic advantage that is just not, you can't, it's not paralleled anywhere in the world. We have the most rivers that can be navigated than any country in the world. We have all these deep water ports. We have Pacific and Atlantic access. We don't technically don't have to worry about invasion, whereas other countries do. So there's just these physical, geographic advantages that some countries have over others. So, and there's a reason, and there's also the politics of taxation and whatnot. So, what you see, and I know you know this, according to your discipline, people in other countries, when they finally figure something out and they're looking at making some real money for themselves going forward, they move to the U.S. Intellectual property law, contract law, lack of confiscation, at least in theory. So there's just a brain drain for a lot of these countries that, you train someone up and they're finally in a position to make something happen and then they just up and move to the US. So I think that plagues India to some degree.
Yeah, I guess that makes a lot of sense. So let me ask you this. I mean, you have a background in computer science. Obviously, there's a lot happening in the technology field right now with crypto, with AI, especially with AI. Kind of, what are your thoughts on all that? Where are things going? What is going to be disrupted um, with all those new technologies and iterations?
Yeah, sometimes I wish I was younger. I'm 52 now. So you and I think we're both Gen X, right?
Yep.
Yeah. So, um, remember when the internet first started becoming popular, like 97, 98? And these pictures that people had in their mind about what we were going to use the internet for. It turned out to be a really, really big deal, but 9 out of 10 ideas didn't pan out. You're not going to be selling cars on the internet. You're not going to be selling dog food on the internet. Um, you're not going to be having Thanksgiving on the internet. It solved a lot of problems. It created some others, but most of it was nonsense. I feel the same way about AI. So I have a couple of different AIs that I use, not in the business, certainly not for trading. That's a big no-no. We can talk about later if you want, but um, and I play around with them and I build things and I have them do work, and they're really, really good at certain things. I mean, 99% reduction in wasted time, cost reduction. They're just amazing at it. At other things, it's like giving a baby a machine gun. You don't want to let them do it. It's crazy. So you got to figure out what those things are. And the AI is evolving and getting better, faster. In some ways, it's getting worse. Like my AIs, they're making them so politically correct now and so polite that you can't trust them, right? They'll agree with anything you say. So you have to get in there and write your prompts so that they don't do that. Um, and the fact that you don't control it, right? And it's not your data anymore. Like you type this stuff in and all that stuff's getting sucked up into a massive database and somebody else is, basically churning that or mining that data and taking out the best ideas. So there's just a lot of dynamics going on there with AI. I do think it's going to be deflationary for a lot of jobs, which some people would argue is a good thing. It's just going to create lots of unemployment problems, though, for kind of low end old school jobs like editors and stuff like that. There's absolutely no compelling advantage that they have over an AI. So a lot of customer service type stuff. So it's going to be very, very disruptive. But again, I'll go back to what we were talking about earlier. I don't know. Like prediction is like the telephone game. I tell you something, you tell your wife something, she tells the gardener something. By the time it gets back to me, it's the exact opposite of what I said. That's the same thing with these predictions. I'm trying to predict, 3 years out or, third order thinking. We have no idea.
Yeah, no, it's interesting. So why not use it for trading? You'd mentioned that. What's the reasoning?
Hmm. How do I keep this concise? Uh, well, if you're going to extract wealth out of a market, if you're going after a sustainable risk premia, something that's real, they exist, and they're not unidentified. And you don't create new ones. It's not alchemy. You can't create new structural risk premia in the markets. They're either there or they're not. And I don't think there's any undiscovered or any meaningful undiscovered risk premium. So if you take the AI and say, go find me something that works that I don't already know about, it'll find it in the spurious correlations, and it's basically going to find nonsense. That's my experience, and that's my understanding and belief about the market. So you're much better off pursuing risk premia that you understand, that you deserve and earn, and suffer the consequences of it. Eat that volatility, take that risk, blend your risks together intelligently at the portfolio level, and don't be fooled by AI telling you that there's some other risk premia, but it can't distinguish whether it's real or not. So, in other words, what I'm saying is there's not a lot of new stuff to be discovered about harvesting risk premia out of the markets. So, a whole new tool which complicates everything, and can easily be fooled by spurious correlations and equity curves isn't the answer to that. Plus, you can't like AI, you can't, who's accountable at the end of the day, right? When you're managing money, the buck has to stop with someone. You can't just point to the computer and say the AI said to do it. I don't know what to do. Like that's a regulatory nightmare.
Yeah, it's actually a good question. Have the regulators, because I believe there are probably people who are using AI for trading in one way, shape, or form. Have the regulators given an opinion on that one way or the other?
Not that I'm aware of, other than there's a lot of pressure to just don't go down that road. Like if you put even one crypto or AI thing in your portfolio, all of a sudden you've got paperwork to fill out, and there's 16 different chief compliance officers at all the different custodians that now want to talk to you about what you're doing because they're scared.
Yeah, yeah. No, we're certainly not going down that road, but it's interesting to think about and how if all else being equal, which of course it's not because it's a lot of times it's not accurate, but all else being equal, wouldn't they all just shave off all of the potential profits if they were, competing against each other? I mean, isn't that kind of how it would end up working?
Well, in theory, if you model all that out, essentially all risk premia gets squeezed down to the risk-free rate of return plus whatever the inconvenience yield is for you doing it or not doing it. Um, that's the Star Trek version, if you take it to its ultimate conclusion. And I'd say that from the 1970s until now, we're probably about halfway there. And there's going to be some equilibrium before you get there, but it's fine though. That's okay because, like for example, we try to collect a risk premium in commodities, right? And if I distill that down to some sort of a expected Sharpe ratio or Sortino ratio or whatnot, I get the same thing from every asset class as an expectation going forward. And as markets get more liquid and more people come in, the alpha component does get diluted a little bit. Now it has a floor because there's a certain amount of alpha that if you can't get it, no one's going to pursue it, right? So they're going to back away, and then it'll kind of go back up. This is all in theory, by the way. I can't prove any of this. So, um, a lot of the risk premium that we're going after is so uncomfortable to traditional investors on a standalone basis that there's just not a lot of competition for it. Now, it is comfortable if we blend it in with risk assets. All of a sudden, now they get the benefit, and people say, "Oh, well, that's okay, right?" But if they have to go out and try to harvest it themselves on a standalone basis, it's a nightmare. So that's just a nice side effect of our industry is that the valuable alpha looks toxic on a standalone basis, but it's actually quite beneficial if it's blended in with risk assets.
Yeah, no, that makes sense. So let me ask you this as we get close to wrapping it up here. When you look at an asset like crypto, for example, right? There's obviously a lot of ink being spilled about crypto right now, and you know, a lot of the kind of the macro investors are talking about there are very few things you can invest in now to keep pace with inflation or exceed inflation with a portfolio. One being tech, which is why so much money's going into the Magnificent Seven, um, and also with crypto. So, what's your kind of standpoint on that? Because realistically, if we're in a high inflationary environment, it's going to be hard to keep pace. And if you have these easier kind of methods of keeping pace with inflation. Kind of what's your opinion on that at the moment?
Scared, intrigued, but scared. It's crypto. My problem with crypto has to do with the fact that the government gets to decide whether you're a criminal or not by using it. There's nothing stopping them from saying, this is causing a problem and we don't need to get in there and mess with it. We just need to designate anyone who uses it as a terrorist, a financial terrorist or something. The new Patriot Act, 2.0 for some. I'm not saying they will do it or if it's even likely. But if it causes enough problems for them and they just want it to go away, it's just the Senate. That's it. So if crypto fulfills its mission, it's going to put a lot of pressure on the government and the fiscal situation or the monetary situation. So I look at it and say, well, why? It's a risk, right? I don't have a problem owning crypto a little bit. It's like any other asset, but the payoff structure has this downside component that I can't control that. I can't hedge it. I can't, use a stop loss. I can't solve that risk. It's just a risk you have to take. But smart people that were, coming up with a rebuttal would say, well, that's true of everything. The internet, Amazon, all these things that worked out, there was this wall of worry going forward. But when I look at it, the game theory to me says, well, the ultimate decision makers in the world are the governments when it comes to, currency and whether something's legal or not. And they don't like it. And I don't think they're going to like it in the future because it's going to cause problems for you. Will they be able to stop it? There's a chance they won't. Like the decentralization trend may just run circles around them. In that case, what happens to them then and all that debt, right? So, yeah, I don't know. I'm not a like a Bitcoin maximalist. I understand their argument, but my game theory is looking at all the other players and wondering, when if their survival's on the line, are you really factoring that in or not? So cut to the chase, 2, 3, 5, 8% in crypto is not the end of the world. But realize this thing has tremendous downside potential, even if it fulfills its mission. The world governments could just decide we're just not going to allow this.
Yeah, and that's always been the argument, and China tried that and failed. And I think um, I think it's harder for them to stop it from a regulatory standpoint, especially with ETFs now and futures. I think that'd be hard for them to just say, sorry, we're not going to allow it. They could tax it to death, though.
Yeah,
100% return, 100% tax on gains. That would kill it. That's all I have to
yeah,
do. I mean,
yeah,
people get into these elaborate schemes. I'm like, just tax it to death. That's all I have to do.
yep,
Um, but what's interesting to me is, I think about um, I think about like the future of crypto as an asymmetric risk trade, right? If you can get a 3-to-1 upside to downside, it could go to zero or it could go up. I mean, in my opinion, it could go up to a million a coin. Some people say a lot more, but let's say a million a coin. You're looking at 10x, 10-to-1. Is that a trade you do? Yeah, I do it every day of the week, right? I mean, 10-to-1 upside. Let's say you got a 50% chance of one versus the other. Why wouldn't you do that trade? I mean, that's how I look at it because I assume it's going to go to zero. Like, I assume that is a very reasonable expectation. I don't think it will, but you have to assume that. So that's kind of how I've always looked at it. Is I don't really care either way. I just see it as an opportunity, and if it makes sense, great. You put a percent, like you said, you put a meaningful but non-meaningful percentage of the portfolio, and just see what happens, right?
yeah.
Um,
Well, in fact, I could revise my answer too. It doesn't matter, right? It's you structure it. You structure an asymmetric payoff, and you calculate the odds of being right or wrong. You position size it accordingly, and you let it happen, let it go. You're either going to win or you're going to lose, but make sure it's a portion of the portfolio. That's why I don't, get married to any of these concepts because things change.
Let me ask one final question, just because I just started doing some research on this past weekend. Have you looked into what Michael Saylor is doing with this company, with the whole basically financial engineering around crypto?
Yeah, I started just a few days ago. Had a bunch of people pinging me about that, but I'm not qualified to pass judgment on it yet. Like you, I haven't really gone deep. Yeah.
Yeah, it's interesting, but it just doesn't. As I've been telling my buddy who's very pro crypto, I was like, it's very interesting. Like I'm gonna give it some time to research it, but it also feels like a Ponzi scheme. Like it feels like I can't put it into words, but more of a just like you, been around the block a few times. I experienced 2008. Like I saw what was happening, and everything was fine as long as real estate always goes up, right? And the day that it doesn't, everything falls apart. It feels like that, like not exactly, but it feels like it should fit into that bucket. And I'm trying to give it its due, but at the same time, it just feels like this can't be. It'd be too easy. Why isn't everybody else doing it? It just doesn't make sense. So
Well, you'll probably agree with this. Being early in this business is the same thing as being wrong. Pioneers get arrows in the face. It's settlers that come in and make all the money right after. So pioneers take what I call uncompensated risk. And a lot of times you'll see, and I don't know Michael Saylor, but a lot of times the pioneers are driven not by expected value, but by ego. And ego is the enemy of expected value. So you don't want to be first. You don't want to be second. I call it the third mover advantage. Let it shake out. Let them take the arrows and seek the fame, because no one's going to be writing books or making movies about me. But I expect to compound at a reasonable rate for this long marathon and just have a nice pool of capital and an enjoyable life along the way. At the end, I don't need a Ferrari or a book or any of that stuff. Those are uncompensated risks. If I'm a steward of the capital, not the ego. So these things are interesting and right on time. We're taking a look at what they're doing. Watching what the pioneers are doing, and they take all the arrows and then figure out if there's any merit to it later on. But personally, I don't see any. There's no advantage to your base of capital to first mover advantage. That is a misnomer.
interesting. Well, that's an interesting perspective. I hadn't heard someone with that before, so I like hearing that because I've never heard an argument either way. I've just assumed that, early people. I mean, it's like if you were in Bitcoin in 2009, you'd be pretty well off right now. But at the same time, obviously, back then it was just, it was just kind of fake until people widely adopted it and understood it. So,
Well, I know people that were in Bitcoin since then, but they're the kind of people that get into things like Bitcoin in 2009. So yeah, they made a lot of money on Bitcoin and they lost even more money on the other 77 lures that they chased pre and post, Bitcoin. So it's what you keep. It's not how much you make, it's what you keep, and how much hell did you put your clients through along the way. And being a steward of capital is like being the captain of a ship. The path traveled matters. The experience matters. Making it to your destination matters, and not having to bail water every step of the way or drag yourself off of an iceberg matters. So that's just it's a different mentality, a different philosophy about whether you're trying to predict the next great thing or you're trying to grow wealth at a sustainable manner over time. Those are two different disciplines.
well, Eric, I think that's a great way to end the episode because that's great wisdom, and I appreciate you having you on the show. Where can people find more about you?
Yeah, just go to standpointfunds.com. scroll down a little bit and just type in your email address to our monthly updates, and you'll learn everything you ever wanted to know about Standpoint. And we promise not to spam you with any junk.
Awesome. Well, thanks for coming on, Eric. We'll definitely have you back in the future. Enjoyed the conversation, and I know there'll be kind of more coming up with the macro environment, so I'd be interested to get your take.
Awesome. Thanks, Kirk. Appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Eric. Really appreciate him coming on the show. Now into the panel portion of our show where we have our very own Phil Weiss. Hey, Phil.
Hey Kirk, how are you today?
Doing well. Doing well. Good to see you. And also we have our very own Barb Freeberg. Hey, Barb.
Hi, Kirk. Hi, Phil.
Awesome. Well, so Phil, what were some of your takeaways from the interview?
So, I have to confess that this is not the type of investing that he talked about is not what I would normally do. I just have, I have a tough time with trying to make all these predictions around how I'm investing based on what's going on. I take more of a long-term perspective, and there's a lot more short-term thinking that comes into his global macro approach. Hedge funds in general, they're very expensive, and I like to keep expenses down for the assets that I manage. There's a place for this for those that are interested in it. I'm not saying you can't do it. It's just not something that I regularly would do.
Okay, cool. Barb, what about you? What are some of your takeaways?
Global macro trend following is a type of investing where you look at a bunch of different factors around the globe and look at what assets are performing well at a particular point in time. And our panelists talked about then capitalizing on that and jumping in and out to take advantage of the assets that are doing well. So I understand the concept. I think it is very difficult to actually master and outperform just a basic index fund investing approach. I believe that it is possible, but you'd really have to look if you're choosing to invest in this way. I would suggest that you look at the manager's track record and compare it with a passive 60/40 or 70/30 stock bond index fund portfolio and just see how it compares. Now, he was talking about what went on in the 70s and early 80s, which was everything was pretty flat. I get that. And we do go through periods like that. The first decade of this century, after the big run up in the late 1990s, the big run up in the dot-com stocks. Well, the markets took a fall, and going forward, the first decade returns were very low. So all of these different things happen. Returns go up, they go down, but in general, over long periods of time, the stock market does go up. And if you're investing today, if you're 30, 40, 50, and you're not planning on starting to take your investments out and sell them until you're 70 or 65, then the tried and true, just basic stock and bond portfolio can give you a pretty decent return.
Okay. So Phil, what are your, I mean, we talked about the all-weather strategy in this kind of what are your thoughts on that? I mean that Ray Dalio's one of the big ones that really focus on the all-weather, but what are your thoughts on that kind of investing?
Yeah. I still just not something that I would normally do or recommend because we're talking about we're trying to hedge ourselves against the different bad things that can happen, right? Like that's part of what we're doing. And it's just hard to know what's going to happen. It's when you think about something, we talk about market timing. I mean, to me, there's an element of market timing involved in this approach, and it's something that's really hard to do. And the problem that I have with it too is, okay, this is what's working right now, but when is it going to stop? I don't know. So if you try to pull out of the market because you're worried about where it is, well, how do you know when to get back in? And so that's what I have a tough time for. I mean, I don't look at charts. I'm more of a fundamental investor when I look at individual stocks, or if I look at the market, I'm not a technical investor by any stretch of the imagination. And I think that there's a lot of technical trends, and I'm not saying that that can't work. Like anything can work. It's just that's not something that I would normally practice. I just find it hard to know if I'm following this trend, how do I know when it's stopping? And how do I get out at the right time versus the wrong time? Because if you stay in a trend too long and it works against you, whatever benefit you had from being in it, you can lose.
Yeah, I'm in agreement. I think it's challenging when you're looking at basically trying to predict the future, right? If you're doing any sort of global macro trends, you're trying to predict the future. Maybe you're really good at it. Maybe some people are. I mean, you look at a guy like Stan Druckenmiller, who has a long track record of success. But you also look at people like that who used to have a lot of success because they understood the markets. Now the markets operate differently. I don't understand. I used to understand the markets. I don't understand them anymore. They don't make any sense. The only way they make sense is if you use the framework of gambling. Like, oh, something is going up, so I'm going to invest in it. Momentum following is a form of investing. But if you're a momentum investor, you could do really well. But if you're a value investor, you got your clock cleaned in the last 20 years. It's not because you're doing anything bad. It's just because compared to everyone else, everyone's like, well, I keep putting my money on black and it keeps giving me money back. So I'm going to keep putting my money on black. You could tell that the table's rigged, right? If it was even, it was 50-50, that's one thing, but they keep hitting black. It's like, well, might as well put all my money on black until one day they just clean the table and just take everybody's money. It was what ends up happening. But I think the challenge is personally, things like all weather portfolios, which is really fascinating to me if you understand how they really work. The challenge is, I think, even a guy like Ray Dalio, he's not going to have the same kind of success when you're reliant upon leveraged bonds. If you're trying to leverage up a bond portfolio, that's great if they're going down, but if they're going up, you could lose a lot of money doing that. And so, I think that the challenge is does it, there is no all-weather portfolio. There's nothing that works all the time. It just doesn't exist. If it did, everyone would have it, which means it wouldn't work because everyone's doing the same thing, which basically takes away the profit motive for anyone to do anything different. So there's basically ends up being no profit from it. So having varieties is what causes things to do well. But I don't know. I mean, you got these portfolios, they're basically 2 and 20. I mean, what are your thoughts, Barb? I mean, are they worth it? I mean, you see all these people. I know Phil wasn't hot on it. You mentioned that early on, but what are your thoughts, Barb?
I'm cheap. I don't want to pay a lot of money for fees. I'll just put it out there. And if I can get a decent return and keep fees low, that's where I'm going to go. Now, hedge funds typically promise fabulous returns. In exchange for that, you're going to pay very, very, very high fees. And on occasion, they deliver after fees, but not always. And so, what you have to realize, you are taking a risk just walking in that door because you've got to make a return above the certain fee level. So that's kind of where I get in. I mean, that's one of the reasons that I'm kind of not a big fan of hedge fund type investing. Another thing apart from fees is that um, when you're investing, if you like this type of strategy and there are other ways to get what might be called an absolute value or a more protection against losses, which is pretty much what this type of strategy is doing. They promise that they'll give you gains, maybe not as good as when the stock's at its highest point, but you also won't get those types of losses. You can invest in an actively traded absolute value ETF or mutual fund, and those fees are much lower. And so you can do that kind of on your own. And again, Kirk, I'm taking it to you. Okay. So get ready, get your armor up. I agree that the markets are a little bit crazy because they're not following valuations. They have not been following valuations for quite a while. The basic market has been very overvalued. I don't think it's gambling. Okay. Because I do believe that over the long term, and I mean, more than 10, 15, 20 years, you're going to see value come into play because nobody wants to overpay for an asset forever. And so that's actually what happened in the early 2000s was the assets, the dot-coms got so overpriced that the market finally crashed and said, wait a minute, I'm paying too much for these assets. So I am not going to do it anymore. And that's when the market crashed.
Yeah, I think the problem, Barb, is I agree with you. The problem is it's been 20 years. So, it's one thing like it used to be, where things would fluctuate in and out of favor, and then you had the 90s when pretty much just all tech all the time. But the early 2000s was decent. You had some value, some growth, and it was more normal-ish. But honestly, since 2009, it's just been all growth all the time. And value's just been out of favor. And I'm a value investor. It makes it very difficult for somebody with the way I think of the world. Like I want to buy something. I don't buy cheap, Barb. You can buy cheap. I'm buying thrifty. So
Okay, yeah.
I'm thrifty. I'm not cheap.
Gotcha. Sure, sure. I get it. Yeah. And I think one of the problems with this conversation we're having today is we're all in a similar kind of mindset in terms of our investing strategies. And so, but we do want to be fair because in reality, look, there are a place for other types of strategies. People who time the market, or people who invest with a momentum strategy or a trend following strategy. There are people that succeed in that. Probably not a lot, and you may not even know about them because they may not broadcast their success. So I think I want to be out there and saying it's not my style, but if you want to try this type of investing, give it a try, see if it works for you.
Yeah, and another just kind of final thing before we wrap it up here is it doesn't have to be all or nothing, right? It doesn't have to be you put all your money in this or nothing. Um, I mean, I don't know too many people who do that, unless you're a fund manager. That's what you do for a living. But I think most people have a diversified approach so that, you can try this and you can try other things, and together they should diversify both your approach as well as the assets. But I certainly did like his perspective. I do think there's a lot of opportunities coming up. While I've been saying for a while, I think we're going to be a repeat of the 70s. It certainly feels like that in many ways. But we certainly don't know, and it's certainly not going to mirror it. It may rhyme, but it's not going to mirror it. So as we kind of wrap it up, Phil, any final thoughts you want to leave our listeners with, with this type of global macro, all weather, trend following, like where's your head go with this?
I think the most important thing you just said there about this whole conversation is diversification, right? You have to invest in a diversified portfolio. If you want to allocate some of your funds to some type of global macro or trend following approach, decide how much you're willing to put there. It's not an all or nothing. Maybe it's 5%, maybe it's 10%. That depends on you. Maybe it's 2%. But if you want to put something there, do it. But then when you do that, pay attention to it. It's whatever it is, and see if it works and have a process. Because to me, one of the most important keys to successful investing is having a process that you can stick to. Because if you have a process, it's a lot easier to figure out where you're going right and where you're going wrong than if you don't have a process. Because you can be successful when you don't have a process, but it's probably just dumb luck. It's like when I get the emails from clients saying, so and so said the market's going to go down. And I immediately look them up, and you'll find that they've said this like clockwork over and over and over again. And my answer to them is, look, could they be right? Sure. But they've been saying this for a long time. Even a broken clock is right twice a day. So yeah, it's possible, but I'm not going to make a bet on it. I take the view when we're investing that we are taking a long-term view that the market's going up. And if that's the case, I want to stay invested, and I'm not going to worry about those people that are forecasting doom and gloom. As for me, I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you're facing a new beginning, you can take our Flourish to Life's Big Changes assessment at apprisewealth.com/assessment to discover how ready you are to embrace and thrive through your significant life transition. You can also sign up for our blog. Thanks for having me, Kirk.
Thanks for coming on, Phil. Barb, final thoughts from you.
Kirk, Phil, I liked what you said. Just, if you want to try out a more unusual strategy, a global macro, a trend following, a momentum strategy, you don't have to do it with all your money. And I want to reiterate what I said before. There is a huge trend today in particularly ETFs, actively managed ETFs, of trying out some of these types of strategies within the ETF. And of course, you can find them in mutual funds as well. And it's a super easy and relatively low cost way to try out a different strategy. You can put some money in it, see how it does. If it surpasses your expectations, then maybe you found something that works for you. I'm Barbara Friedberg. You can find me online at YouTube or at Barbara Friedberg Personal Finance. See you next time.
Great. Thanks for coming on, Barb. Thank you both. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.